All right, let's kick off another deep dive. Today we're taking a closer look at the S&P 500.
Oh, interesting. What angle are we exploring today?
Well, we're actually talking about alternative ways to invest in it. I was reading this article from the Motley Fool, and it really got me thinking.
I see, I see. Always good to challenge the conventional wisdom. What's the article's main point?
It's about this idea that just blindly pouring money into any ETF that tracks the S&P 500 may not be the smartest move right now.
That's intriguing. Why not? Isn't the S&P 500 usually considered a pretty solid long-term investment?
Yeah, generally it is, but the article dives into this concept of the Magnificent Seven.
Ah, yes. Those mega-cap tech companies that are basically dominating the index right now. Apple, Microsoft, the usual suspects.
Exactly. They're the ones driving a huge chunk of the index's gains these days, which sounds great on the surface, right?
Sure, who doesn't love big returns? But as with anything, there's a flip side.
And what's the downside here?
Well, the risk is that if these giants stumble, if their growth slows down or they face some unforeseen challenges, it could drag down the entire index with them.
So it's like putting all your eggs in one basket, even if it's a seemingly very strong basket.
That's a good way to put it, and that's where these alternative approaches to investing in the S&P 500 come in. The article specifically suggests looking at two ETFs from Invesco.
You mean the Invesco S&P 500 Equal Weight ETF, or RSP?
That's one of them. The other is the Invesco S&P 500 Revenue ETF, or RWL. They each offer a different way to play the S&P 500 game.
Okay, I'm definitely interested to hear more. Let's break these down one by one, starting with RSP. So how does this equal weight thing actually work?
Well, with the traditional S&P 500 ETF, the companies are weighted based on their market capitalization, right? So the bigger the company, the more influence it has on the ETF's performance.
Makes sense, but RSP flips that on its head, right?
It does. Instead of giving more weight to the giants, RSP gives each of the 500 companies in the index an equal slice of the pie, regardless of their size.
So even a relatively small company like, say, Palantir would have the same impact as a behemoth like Apple.
Exactly. It's about leveling the playing field and ensuring that no single company, even those Magnificent Seven, has an outsized influence on the ETF's performance.
That's pretty interesting. I actually looked up RSP's holdings, and the article was right. Palantir is the largest holding, but it only makes up 0.33% of the ETF.
Yep. Quite a difference from traditional S&P 500 ETFs where the top holdings can be 5%, even 10% or more in some cases.
Right. So by spreading the weight more evenly, RSP aims to reduce volatility, right? Like if one of those mega cap companies takes a hit, it won't drag down the whole ETF as much.
That's the idea. It's a way to diversify your S&P 500 exposure and potentially make your portfolio a bit more resilient to market swings.
So it sounds like RSP could be a good option for someone who's a bit more risk-averse, who wants to participate in the potential growth of the S&P 500, but without putting all their chips on those mega cap companies.
It could be. Of course, it's important to remember that there's no free lunch in investing.
Meaning, what's the trade-off with RSP?
Well, because it's more diversified, it might not see the same explosive growth as a traditional S&P 500 ETF when the market is booming, especially if tech stocks are leading the charge.
Ah, I see. So there's always a balance to strike, right?
Exactly. Higher potential returns usually come with higher potential risk, and vice versa.
Makes sense. Okay, so we've got a good grasp on RSP now. What about that second ETF you mentioned, RWL, the one that weights companies based on revenue?
Ah, yes, RWL, that one's fascinating. Instead of looking at market capitalization, it ranks companies based on their top-line revenue.
So it's more about actual sales performance rather than what the market thinks a company is worth.
Precisely. It's a very different way of thinking about size and influence within the index, and it leads to some interesting outcomes.
Like what? I'm really curious to see how the top holdings giving out in this ETF.
Well, for starters, the top three holdings in RWL are Walmart, Amazon, and United Health Group. Together, they make up about 10% of the fund.
That is interesting. Walmart at the top, I wouldn't have expected that.
It's a testament to the power of consistent revenue generation. Walmart might not be as flashy as some tech companies, but it's a cash flow machine.
I guess it's easy to overlook those steady giants sometimes.
It is, but RWL's weighting system brings them to the forefront.
Now, I'm assuming this revenue-based approach also leads to a pretty different sector breakdown compared to a traditional S&P 500 ETF, right?
You are absolutely right, and it's one of the most striking things about RWL. You see, while tech stocks dominate traditional S&P 500 ETFs, in RWL, they only make up a little over 10% of the holdings.
Wow, that's a huge difference. So what sectors are taking center stage in RWL then?
Healthcare, financials, and consumer staples. These are sectors that tend to generate consistent revenue streams regardless of the economic climate, making them particularly appealing in a revenue-weighted ETF.
So with RWL, you're getting exposure to a very different slice of the S&P 500, one that's less dependent on the ups and downs of the tech sector.
Exactly. It's about diversification and potentially finding a smoother path to long-term growth.
This is really making me think about the different ways we can approach investing, even in something as seemingly straightforward as the S&P 500.
That's the beauty of it. There are always different angles to explore, different strategies to consider. And these two ETFs, RSP and RWL, they offer some really interesting food for thought.
I agree. I'm already starting to think about how these might fit into my own portfolio, weighing the pros and cons and really thinking about what aligns best with my investment goals.
That's the right mindset to have.
So for our listeners out there, what would you say is the key takeaway here? What should they be thinking about as they consider these alternative ways to invest in the S&P 500?
Well, I'd say the biggest takeaway is that there's no one-size-fits-all approach.
Right. It's not just about blindly following the herd.
Exactly. What works for one investor might not work for another. It all comes down to your individual goals, risk tolerance, and investment philosophy.
I think that's a great note to end on. Take the time to understand your options, do your research, and make informed decisions that align with your overall financial plan. And hey, maybe RSP or RWL will be the perfect fit for you.
Who knows? They just might be the hidden gems that bring balance and stability to your portfolio.
Well said. All right, listeners, that wraps up our deep dive into alternative ways to invest in the S&P 500.
We hope you found it insightful.
And be sure to join us next time for another deep dive into the world of knowledge and discovery.
Until then, happy investing. It's about acknowledging that too much reliance on just a handful of companies can be risky, no matter how dominant they seem today.
Yeah, that makes a lot of sense. And, the article I mentioned that RSP has a really low expense ratio.
Oh, absolutely. It sits at a very appealing 0.2%.
Which is great for investors because
It means more of your money is actually working for you instead of going towards fees.
and over time, even those small differences can really add up.
Right. Oh, absolutely. Over the long run, that lower expense ratio can make a noticeable difference in your overall returns.
That's really good to know. So RSP seems like it offers some solid benefits, but I'm also curious about its performance. You mentioned earlier that it might not see the same explosive growth as a traditional S&P 500 ETF when tech is booming.
Right. But on the flip side, RSP has historically held its own and even outperformed traditional S&P 500 ETFs when tech isn't the dominant force in the market.
Interesting. So it's not always about chasing those high-flying tech returns, but finding a more balanced approach.
Exactly. Think of it as a smoother ride over the long haul, less prone to those dramatic ups and downs that can come with a heavy tech concentration.
So it's more about consistency and managing risk.
Precisely. And that can be particularly appealing for investors who are maybe a little bit more risk-averse.
Okay, so we've covered a lot of ground with RSP. Now I'm really excited to dig into that second ETF you mentioned, RWL, the one that weights companies based on their revenue instead of market cap.
Yes, RWL, it stands for the Invesco S&P 500 Revenue ETF, and it offers a really fascinating perspective on the S&P 500.
So instead of focusing on a company's size in the stock market, it prioritizes its actual earning power.
That's the core concept, and it can lead to some surprising results.
Like what? Give me an example.
Well, for instance, the top holding in RWL is actually Walmart.
Really? Walmart? I wouldn't have guessed that.
It's easy to underestimate those steady, reliable companies, but Walmart's massive revenue stream puts it right at the top of the list in RWL.
I guess it goes to show that sometimes the most powerful companies aren't always the flashiest ones.
Exactly. They're the ones quietly generating consistent revenue year after year.
Okay, so RWL prioritizes those revenue powerhouses, but how does that translate into its overall sector allocation? I'm assuming it's quite different from a traditional S&P 500 ETF.
You're absolutely right. While tech stocks typically dominate traditional S&P 500 ETFs in RWL, they make up a much smaller percentage, just a little over 10%.
Wow, that's a huge difference. So which sectors are more prominent in RWL?
Where you'll find a greater emphasis on healthcare, financials, and consumer staples.
Interesting. And those sectors tend to be a bit more stable, right? Less prone to the wild swings we often see in tech.
They do. They often generate consistent revenue regardless of what's happening in the broader economy, so they fit well with RWL's revenue-focused approach.
So with RWL, you're essentially getting a very different exposure to the S&P 500, one that's potentially less volatile and less dependent on the performance of the tech giants.
That's the main idea. It's about diversifying your S&P 500 exposure and potentially mitigating some of the risks associated with overconcentration in certain sectors.
It seems like RWL is a good option for investors who are looking for a bit more stability and balance in their portfolio.
It could be, especially for those who believe that strong fundamentals like revenue generation are key indicators of long-term success.
Okay, so we've got these two really intriguing ETFs, RSP and RWL, both offering unique perspectives on the S&P 500. What are some of the key things our listeners should consider as they try to decide which one might be right for them?
Well, I think the most important thing is to really think about their own investment goals and risk tolerance.
Right, because even though these ETFs are both tracking the S&P 500, they can behave quite differently depending on their underlying methodologies.
Exactly. It's not a one-size-fits-all situation. What works for one investor might not be the best fit for another.
So it's all about finding the right tool for the job.
Precisely. And that requires a bit of introspection and understanding what you're hoping to achieve with your investments.
So it really comes down to figuring out what you're looking for and what you're comfortable with.
Exactly. If you're someone who's maybe a bit more risk-averse and you like the idea of spreading your bets more evenly, RSP with its equal weighting might be worth a closer look.
Right, it's like diversifying within the diversification.
Yeah. And if you're drawn to companies that are generating strong, consistent revenue, regardless of market hype, RWL with its revenue-based approach might be more your style.
And of course, there's always the option of sticking with a traditional market cap weighted S&P 500 ETFs if you believe those mega cap companies will continue to lead the charge.
Exactly. It's about weighing the options and choosing the approach that aligns best with your investment philosophy.
This deep dive has really opened my eyes to the different ways we can approach even something as familiar as the S&P 500, It's easy to fall into that trap of thinking, oh, it's the S&P 500, it's all the same, but it's clearly not.
Not at all. These ETFs might be tracking the same index, but the way they go about it can have a significant impact on your overall returns and the level of risk you're taking on.
Exactly. It's like choosing between different routes to the same destination. Some might be more scenic, some might be faster, and some might be bumpier than others.
Yeah, that's a great analogy. It's about finding the path that suits you best.
Well said. So as we wrap up our exploration of alternative ways to invest in the S&P 500, what's the one key message you hope our listeners will take away from this?
I'd say the most important thing is to remember that there's no one-size-fits-all approach to investing. What works for one person might not work for another. So take the time to do your research, understand the risks and rewards of each option, and make informed decisions that are right for you.
And don't be afraid to think outside the box, Explore different strategies, challenge conventional wisdom, and who knows, you might just discover a hidden gem like RSP or RWL that perfectly complements your portfolio.
Exactly. Be curious, be informed, and most importantly, be confident in your own investment choices.
I love that. All right, listeners, that concludes our deep dive into alternative ways to invest in the S&P 500. We hope you found it informative, and as always, we encourage you to continue exploring and expanding your investment knowledge.
And remember, the journey of investing is all about learning, growing, and ultimately achieving your financial goals.
So until next time, happy investing.
Happy investing.